They crashed silver 26% in one day. Then this happened. January 30th, 2026. Silver collapsed from $110 to $72 in a single trading session, the largest one-day crash in recorded commodity history. 1.586 billion ounces traded, more than double the world's annual mine production in just a few hours. But here's what they don't want you to see. Within 72 hours, the same institutions that engineered the collapse started buying physical metal at volumes never recorded before. COMEX vaults lost 26% of their inventory in 7 days. Shanghai traders are paying $20 more per ounce than New York prices right now. And March delivery obligations are about to collide with an inventory crisis that makes 2008 look like a practice run. This is not market correction. This is controlled demolition, followed by strategic accumulation. And the timeline starts now. Welcome to Silver Collapse Coming. In business, the most expensive lessons are the ones we learn too late. The warning signs were always there. We just weren't paying attention. If you're someone who values straight talk about markets, who prefers data over hype, and who believes that protecting what you've built matters more than chasing what you've missed, then you're in the right place. Take a moment right now and subscribe to this channel, not because we're asking for a favor, but because the next few months in silver markets will separate those who saw it coming from those who wish they had. This isn't entertainment, this is strategic intelligence for serious people. And we'd like to know, where are you watching this from today? What part of the world? What's your perspective on what's happening in commodity markets? Drop a comment below. Let's build a community of people who think critically, not emotionally. Now, let's examine exactly what happened on January 30th and why it matters more than any financial headline is telling you. January 30th, 2026 started like any other trading day for silver investors. The metal was hovering around $110 per ounce. Steady, unremarkable. By 9:30 a.m. Eastern Time, the opening bell rang on the COMEX futures exchange. What happened next defied every conventional understanding of how commodity markets function. Within minutes, silver began falling, not gradually, not in response to news, but with mechanical precision. By 10 a.m., the price had dropped to $95. By noon, $85. By market close at 4 p.m., silver sat at $72 per ounce, a 26% collapse in a single day. To put that in perspective, imagine a business owner watching their company's value drop by 1/4 between morning coffee and afternoon tea. That is what silver investors experienced on January 30th. The official narrative was simple. President Trump had nominated Kevin Warsh as the next Federal Reserve Chairman. Markets interpreted this as a signal. Higher interest rates were coming, tighter monetary policy, a stronger dollar. Commodities typically fall when the dollar strengthens. Silver, being a commodity, followed the script. But experienced market observers knew something was wrong with this explanation. The trading volume that day revealed the truth. COMEX recorded 1.586 billion ounces of silver traded in that single session. To understand how absurd that number is, consider this. Global silver mines produce approximately 800 million ounces per year. In one day, traders move contracts representing double the world's annual mine production. This was not organic selling. This was algorithmic execution at institutional scale. The open interest data told an even more interesting story. Open interest measures how many contracts remain active at the end of trading. On January 30th, trading volume reached 345% of the closing open interest. That means positions were being opened and immediately closed, over and over throughout the day. After the session ended, 1.127 billion ounces worth of contracts had been closed out entirely, gone, vanished from the books. The March contracts, which represent a primary delivery month where traders must either provide physical silver or roll their positions forward, saw the most aggressive activity. Traders were exiting March positions as fast as the system would allow. Why would someone holding a March delivery contract, which gives them the right to receive physical silver, suddenly panic to close that contract at massive losses? The answer came from an unexpected place. Physical silver dealers. While paper silver markets were experiencing their worst day in history, something extraordinary was happening in the physical world. SD Bullion, one of America's largest precious metals retailers, reported transaction volumes 2.5 times higher than their previous all-time record. That previous record occurred during the Silicon Valley Bank collapse in March 2023, a moment of genuine financial panic. Friday's physical demand exceeded what SD Bullion had processed in entire months during 2025. Other dealers reported similar patterns. Phones ringing constantly, websites crashing from traffic, inventory moving at rates that required emergency calls to suppliers. The divergence between paper and physical markets had become a canyon. Business professionals understand what this pattern suggests. When the price of something crashes, but physical demand explodes, one of two things is happening. Either the price is wrong, or the physical buyers are fools. The smart money bet on the former. By February 3rd, just 4 days later, silver had recovered to approximately $86 to $80 per ounce, a 20% rebound in less than a week. This recovery occurred despite mainstream financial media maintaining bearish commentary on commodities, despite continued predictions that Warsh would crush precious metals with higher rates, despite the narrative saying silver's bull market was over. The velocity of the crash, followed by the velocity of the recovery, pointed to something beneath the surface. Markets do not naturally move this way. Organic selling creates gradual declines. Organic buying creates gradual recoveries. What happened in late January and early February looked like something else entirely. It looked like an engineered shakeout followed by strategic accumulation. The question was not whether manipulation had occurred. The trading patterns made that statistically obvious. The question was why and what happened next. The answer lay in COMEX vaults, where the physical silver supposedly backing all those paper contracts was stored. And in those vaults, something unprecedented was happening. Something that made the January 30th crash look like a distraction from the real crisis developing behind closed doors. There's a number that keeps commodity traders awake at night. 104 million ounces. That is how much registered silver sits in COMEX vaults as of early February 2026. Registered silver means metal that is available, verified, and ready for delivery against futures contracts. It is the physical backing that makes paper trading theoretically legitimate. On the surface, 104 million ounces sounds substantial. It is a large number. But context changes everything. Remember that on January 30th, traders moved 1.580 billion ounces in paper contracts. If just 10% of those traders had demanded physical delivery instead of closing their positions, they would have needed 158 million ounces. The vaults held less than 2/3 of that amount. But the real story is not about what the vaults hold today. The real story is about what they held last month and where that silver went. Between early January and mid-January 2026, something remarkable happened. Physical silver began leaving COMEX warehouses at unprecedented rates. In just 7 days, 33.45 million ounces were withdrawn from registered inventory. That represents 26% of available silver gone in 1 week. Business owners understand inventory velocity. They understand supply chain management. They know that when inventory disappears faster than it can be replenished, problems cascade quickly. The same mathematics apply to commodity vaults. If withdrawals continued at January's pace, COMEX registered inventory would drain completely in less than 4 weeks. Not 4 months, not 4 quarters, 4 weeks. The timing of these withdrawals raises questions that institutions prefer not to answer. January marks the approach of March delivery obligations. March is one of 4 primary months when futures contracts mature and holders must make a decision. Roll the contract forward to a later date, close the position entirely, or take physical delivery. Historically, most traders choose the first 2 options. Taking physical delivery involves logistics, storage costs, insurance, transportation. It is easier to simply roll forward or cash out. But January 2026 showed different behavior. Traders began pulling metal early. They were paying premiums, absorbing extra costs, to take possession of physical silver weeks before their contracts required it. This behavior suggests something specific. It suggests belief that waiting carries risk. When market participants demonstrate willingness to pay additional costs to secure physical possession earlier than necessary, they are telegraphing concern about future availability. One institution's behavior stood out with mathematical precision. J.P. Morgan Chase, the largest silver futures trader on COMEX, closed 633 short contracts at the exact price bottom on January 30th. The exact bottom, $72 per ounce. Either J.P. Morgan possesses extraordinary market timing, or they possessed advanced knowledge of positioning. Given that this same institution has been fined multiple times by regulators for precious metals market manipulation, the latter explanation invites consideration. But COMEX is not the only market showing stress signals. London tells a parallel story. The London Bullion Market Association operates the world's largest over-the-counter precious metals market. It is where institutional players, central banks, and major refiners conduct business away from public exchanges. London silver stocks have collapsed to levels not seen in decades. Lease rates, the cost to borrow silver for short periods, spiked to 200% annualized during acute shortage periods in late 2025. When borrowing costs reach 200%, it means someone desperately needs physical metal and is willing to pay almost any price to obtain it temporarily. Shanghai provides the third data point in this global picture. The Shanghai Gold Exchange operates China's primary physical delivery market for precious metals. Chinese buyers are currently paying approximately $20 per ounce more than COMEX paper prices for physical silver. A $20 premium on an $86 asset represents roughly 23%. This premium exists despite shipping costs, import duties, and normal arbitrage mechanisms that typically keep global prices aligned within tight ranges. When arbitrage opportunities persist, it means something is broken in price discovery. Either Western sellers cannot deliver metal to China fast enough, or Chinese buyers do not trust Western paper pricing. Either explanation points to market dysfunction. India adds another layer to the supply puzzle. Indian silver imports accounted for approximately 25% of global production in 2025. This demand shows no signs of decreasing. Wedding seasons, religious festivals, solar energy expansion, and electronics manufacturing all drive Indian consumption. This demand is relatively inelastic, meaning it continues regardless of price. Cultural and industrial needs do not simply disappear when silver costs more. Industrial users worldwide face an uncomfortable calculation. Silver is irreplaceable in many applications. Solar panels require it. Electrical contacts depend on it. Medical devices use it. Electronics cannot function without it. When supply becomes uncertain, industrial users must choose: secure inventory at higher prices now, or risk production disruptions later. The vault dynamics create a timeline problem. March delivery obligations are approaching, physical inventory is declining, and the gap between paper contracts and available metal is widening. COMEX has mechanisms to address shortages. They can raise margin requirements, making it more expensive to hold positions. They did exactly this on February 2nd, increasing silver margin requirements from 11% to 15%. Higher margins force leveraged traders to exit, reducing overall contract positions. But there is another option the exchange possesses, an option they have used before. An option that would fundamentally alter how silver markets function: forced cash settlement. If physical delivery demands exceed available inventory, COMEX can simply declare that contracts will be settled in cash rather than metal. They pay traders the paper value, and the metal never changes hands. This solves the immediate crisis, but it creates a larger problem. It admits that paper silver cannot be converted to physical metal at stated prices. It admits the system is fractional, and it destroys the credibility of futures markets as genuine price discovery mechanisms. Whether COMEX will need to take this step depends on March delivery demands. And those demands depend on how many traders believe the January withdrawals signal something larger. The mathematics are published daily. The vault reports are public. The inventory levels are visible to anyone who looks. What is not visible is how many market participants are looking, and what they plan to do about it. Wall Street loves historical parallels. They are clean. They are simple. They provide comforting narratives that make complex situations feel manageable. When Kevin Warsh was nominated as the next Federal Reserve Chairman, the parallel was immediate and universal. Paul Volcker 2.0. The story wrote itself. Volcker took control of the Federal Reserve in 1979, facing runaway inflation. His solution was brutal but effective: raise interest rates to whatever level necessary, starve inflation of oxygen, accept the economic pain as necessary medicine. Volcker pushed the federal funds rate above 20% by 1981. Unemployment soared, businesses failed, the economy entered deep recession. But inflation broke. It fell from 13.5% to 3.2% over several years. The medicine worked. Markets crashed silver on January 30th, believing this story would repeat. Higher rates mean stronger dollar. Stronger dollar means weaker commodities. Weaker commodities mean silver falls. Simple, clean, historical. There is just one problem with this narrative. The mathematics do not allow it. Understanding why requires examining a single number that changes everything. In 1980, when Volcker was raising rates to historic levels, United States federal debt stood at approximately 30% of GDP. The government's total borrowing represented less than 1/3 of the nation's annual economic output. Today, in 2026, that number exceeds 125% of GDP. Federal debt is not just larger in absolute terms. It is larger relative to the economy's ability to service it. And that ratio creates constraints that did not exist in Volcker's era. Every percentage point increase in interest rates adds approximately $340 billion to annual debt service costs. This happens because the Treasury must constantly refinance maturing bonds. Approximately $9 trillion in federal debt rolls over each year, combining new, borrowing, and maturing securities that must be reissued. Current annual interest payments on federal debt already exceed $1 trillion. This represents the government's third largest expense, behind only Social Security and Medicare. It surpasses defense spending. It exceeds all non-defense discretionary spending combined. If the Federal Reserve were to raise rates to even 10%, half of Volcker's peak, debt service would potentially exceed $2 trillion annually. That would make interest payments the single largest item in the federal budget. Larger than defense, larger than healthcare, larger than any individual program or agency. At 15% rates, debt service approaches $3 trillion at 20% rates. The numbers become functionally impossible. The government would be spending nearly half its tax revenue simply paying interest on existing debt. This is not political commentary. This is mathematics. The debt to GDP ratio creates a ceiling on how high rates can rise before fiscal crisis becomes inevitable. And that ceiling is far lower than what Volcker deployed in 1980. Kevin Warsh understands this. His previous writings and speeches at the Federal Reserve show clear awareness of debt constraints on monetary policy. He has advocated for fiscal discipline. He has warned about long-term debt trajectories. But he has also acknowledged the reality that central bankers cannot ignore fiscal mathematics. The market's assumption that Warsh will simply replay Volcker's strategy ignores what Warsh himself has written about structural constraints in the modern economy. But there is another factor markets are overlooking. Silver's role in the economy has fundamentally changed since 1980. In Volcker's era, silver was primarily an investment metal. The Hunt brothers tried to corner the market through speculative accumulation. When that bubble burst, silver crashed because the demand was financial, not industrial. Remove the speculators and the price collapses. Today, silver's demand profile looks completely different. Industrial applications now consume approximately 60% of annual supply. Solar panels alone account for roughly 20% of total silver demand. Electronics, medical devices, automotive components, 5G infrastructure, all require silver in quantities that continue growing. This demand is non-discretionary. A solar panel manufacturer cannot simply decide to stop using silver because prices rise. The technology requires it. An electronics company cannot eliminate silver from circuit boards. The physics demand it. The Trump administration's recent policy announcements signal recognition of this shift. On January 28th, just 2 days before the silver crash, the White House announced a $12 billion strategic mineral stockpile initiative. The list includes lithium, nickel, rare earth elements, and implicitly, silver. When governments reclassify materials from commodities to strategic assets, market dynamics change. Price discovery becomes secondary to supply security. National security concerns override pure economic optimization. The U.S.-India trade agreement announced on February 1st commits India to purchasing $500 billion in American goods over the coming years. Energy technology, electronics, and infrastructure comprise major categories. Silver embeds in all three. India's silver demand will not decrease under this framework. It will accelerate. Yet markets crashed silver the day after this announcement. The cognitive dissonance is mathematical. Strong economic data showing manufacturing expansion above 50 on the ISM index. Trade agreements expanding technology exports that require silver. Strategic stockpile announcements treating silver as critical infrastructure. Vault inventories declining at record rates. Shanghai premiums persisting at 20% plus. And yet, paper prices crashed 26% in one day. This divergence suggests one of two possibilities. Either every physical market signal is wrong and paper prices are correct, or paper prices are being managed while physical markets reveal true supply-demand dynamics. The Volcker comparison assumes 1980s conditions, manageable debt levels, speculative commodity demand, discretionary industrial usage. None of these conditions exist today. The mathematics have changed. The debt constraints have changed. The industrial dependency has changed. Markets crashed silver betting on a historical parallel that the numbers do not support. And while traders were selling paper contracts, someone else was withdrawing physical metal from vaults at record rates. Someone who understood that historical parallels only work when the underlying mathematics are similar. The mathematics of 2026 look nothing like 1980, and that difference is about to matter. March is not just another month on the calendar for silver markets. It is a settlement month, a reckoning point. One of 4 periods during the year when futures contracts mature and traders must make final decisions. No more rolling forward. No more Yankee-ing obligations. The contract reaches its expiration, and physical delivery becomes the only option besides cash settlement. The March 2026 contract carries weight that most market observers have not yet calculated. Current open interest in March contracts, even after the January 30th reduction, still represents substantial ounces relative to what sits in COMEX vaults. If delivery demand runs at historical averages of 3 to 5%, the system can fulfill obligations from existing registered inventory without significant strain. But January's withdrawal patterns suggest this March will not follow historical averages. When 26% of vault inventory disappears in 7 days, when traders pay premiums to take possession weeks early, when Shanghai buyers maintain $20 premiums despite arbitrage opportunities. These behaviors telegraph expectations. They signal belief that waiting until March delivery deadlines carries risk. COMEX officials are not blind to these dynamics. The February 2nd margin requirement increase from 11% to 15% was not random timing. Higher margins force leveraged traders to either add capital or close positions. It is a pressure release valve designed to reduce overall contract exposure before delivery obligations intensify. But margin increases only work if traders accept the higher costs. If participants believe a physical silver will be difficult to obtain in March, they may choose to maintain positions despite increased capital requirements. The margin tool loses effectiveness when conviction outweighs cost. The exchange possesses other mechanisms. They can impose position limits, restricting how many contracts any single entity can hold. They can mandate forced liquidations if they determine market conditions require intervention. They have done both before. The 1980 silver crisis provides precedent. When the Hunt brothers attempted to corner the silver market, COMEX changed rules mid-crisis. They implemented Silver Rule 7, which essentially prohibited new long positions and forced liquidation of existing ones. The Hunt empire collapsed within weeks. But 2026 operates under different dynamics than 1980. International participation has exploded. Chinese buyers, Middle Eastern investors, Asian industrial users, European banks all participate in silver markets now. COMEX rule changes bind American participants directly, but cannot force Chinese buyers to stop paying Shanghai premiums, cannot prevent Indian industrial users from securing supply, cannot compel Middle Eastern wealth funds to liquidate physical holdings. The market has globalized beyond any single exchange's control. This fragmentation creates a vulnerability that did not exist in Volcker's era. If COMEX implements forced cash settlement to prevent delivery defaults, it may solve the immediate crisis, but it sends a signal that cannot be recalled. It admits paper contracts are not reliably convertible to physical metal at stated prices. That admission destroys confidence in futures markets as legitimate price discovery mechanisms. And once that confidence breaks, capital flows toward what can be trusted. Physical metal in allocated storage, sovereign coins in personal possession, anything that cannot be settled away with cash payments. Historical precedent offers limited guidance because the structural conditions are unprecedented. The 1980 peak, around $50 per ounce, occurred in a speculative bubble driven by corner attempts. Adjusted for inflation, that $50 equals approximately $180 in 2026 dollars. Silver briefly touched $120 in January before the crash, already approaching two-thirds of inflation-adjusted 1980 peaks. But 1980 was speculation. 2026 is industrial dependency combined with monetary uncertainty combined with vault depletion. The drivers are fundamentally different. The bearish scenario is straightforward. COMEX implements forced cash settlement if necessary. Industrial users accept moderately higher prices as the new baseline. New mine supply responds to price signals over 12-18 months. Markets rebalance at $90 $110 per ounce. Disruption, but manageable disruption. Business as usual with adjusted price expectations. The bullish scenario is structural. Physical shortages force paper prices to converge toward Shanghai's $104 physical pricing. Delivery defaults trigger loss of confidence in futures markets. Industrial users panic buy inventory to secure supply chains. Investment capital abandons paper for allocated physical holdings. Price discovery shifts from COMEX to physical dealers. Silver breaks $150, $200 as the gap between paper fiction and physical reality closes violently. Which scenario materializes depends entirely on March delivery dynamics. Specifically, on how many contract holders decide that physical possession matters more than paper profits. The timeline is measurable. March contracts begin delivery periods in late February. By mid-March, the settlement process completes. That gives markets approximately 4 to 6 weeks to reveal whether physical demand will overwhelm paper supply mechanisms. The data will not lie. Either vaults can meet delivery obligations, or they cannot. Either Shanghai premiums compress back toward COMEX prices, or they widen further. Either sovereign mints catch up on back orders, or delays extend into summer. Business leaders making capital allocation decisions do not need to predict which scenario unfolds. They need to understand that both scenarios are possible, that the probability is non-trivial, and that the March timeline will provide clarity one way or another. The vault numbers are published daily on CME Group's website. The Shanghai premiums are visible in real time through multiple data services. The sovereign mint delays are verifiable through dealer inquiries. The debt-to-GDP constraints are documented in Congressional Budget Office reports. This analysis does not tell business professionals what to do. It presents institutional evidence for independent evaluation. The silver market is signaling structural stress through quantifiable divergences between paper and physical, between Western and Eastern pricing, between stated inventory and withdrawal rates. Whether this stress resolves through paper price adjustment or through physical delivery crisis, the March timeline will reveal. The data is available. The mathematics are clear. The outcome remains to be determined by decisions market participants make over the next 4 weeks. The only certainty is that paper and physical cannot diverge indefinitely. Eventually, one must conform to the other. And when 104 million ounces stands between current market structure and potential system failure, the timeline for that convergence is measured in weeks, not years.